All right. Good evening. This is Joe Scorese at Smart Real Estate Podcast. Back to you with more education, more networking opportunities to support our circle of influence, our network, our real estate professionals in need that during this quarantine and pandemic. The podcast was started back in December 2019 with my co-host Yardell Perkins of Perkintech, and I'm Joe Scorese, obviously a mortgage lending specialist. And the concept was to provide a support to the events that we were holding throughout the greater Philadelphia and South Jersey market. And we were using it as a kind of a follow-up for people that couldn't make one of the events. Then obviously this pandemic came about as of March and quarantine, and we've provided over 100 podcasts to our network and our circle of influence. We're posting this out to over 100,000 people in our database. We're on iTunes, Google Play, Liptify, YouTube, LinkedIn, and Facebook Live as of this evening. We have a follow-up from a family-run business and friends of mine through different organizations I'm involved with. We have Marty and Max Chera. Marty is actually the president of Express Capital Financing, hard money lender, commercial mortgage lender for several years, almost 20 years right now, right, Marty? And we're going to really dig in with Max and Marty about getting started with hard money loans, because obviously this market is completely changed. It's definitely a different look. Definitely a different investor is going to be involved with hard money construction. And Marty and Max are going to break it down in a PowerPoint slide this evening, and then I'll chime in a little bit when there's some questions. And if anybody has any questions, please put those out on the chat. We'll kind of try to get those addressed as we proceed through this. We're going to try to keep it to a solid half hour of good real estate education and provide you guys hopefully some really good breadcrumb to start with or move forward with in your renovation goals when it comes to real estate. So I'm going to hand off and introduce Marty and Max Chera. Guys, why don't you give a little introduction to yourselves, a little background, and then we'll lead right into the education.
Sure. Okay. So hello, folks. My name is Marty Chera from Express Capital Financing. I'm the president and CEO, and I got my son Max on board with us over here on this webinar. And like Joe said, we're here to provide resources, tools, education on growing your real estate business and scaling it, especially in today's environment in real estate. So with that said, I would love to introduce Max. Max is over there. Everybody could say hello and hi. And we'll get the PowerPoint presentation rolling whenever you're ready.
Yeah, that's it.
Yep.
Perfect.
Great. So just to let you know, folks, we're nationwide direct lenders. We're fix and flips and actual bridge loans. What's a bridge loan? You know, for commercial properties, multifamily, mixed use. Those are where the bridge hard money comes into, as well as a commercial mortgage lender, not like what Joe does. And I'll go into that in a little bit to explain this all to you. So today's presentation should not be interpreted as we are not any legal counsel. We are not tax accountant or advisors. This presentation obviously is for educational purposes only. We are not CPAs. We are not attorneys. I'm just giving you my consultative approach as a lender and as an investor myself. So I've been an owner for this company for about 8 years. I used to broker it for the first maybe 5 or 6 years. And the past 8 years, I became an actual direct lender of the hard money and the mortgage lending. We are based, by the way, out of New York City, Brooklyn, New York. And like I said in the beginning, we're nationwide, 46 states. The other states where we don't lend in, you're not going to be doing any deals there anyway, so don't worry about that. We're here to help. We're here to help investors, landlords, developers to create wealth in real estate. So in 2008, when the crash happened, everybody knows it was more about the banking industry that fell into a collapse. Now it's not about the banking industry. Now it's more about income. Everybody lost their job. I shouldn't say everybody, but a lot of people lost their jobs or their businesses. And now it became more of an income situation versus a banking situation when the bankings and the loans and the products and the programs collapsed at that time. So now more than ever, hard money financing products and programs are used for investors, which I'll delve more deeply into. So hard money lenders primarily work with investors that provide capital to get their deals done. How do we get your deals done? Well, everybody's looking for deals out there. Hard money is to provide high leverage, low risk, low deposit, and the less you put down and the more higher leverage everyone gets, the higher return on the investment and the higher your profits will be. So we just went over what hard money is. It's quick, it's easy, it's short term, and again, providing high leverage, low risk, low deposit for the investors. So we're going to go into the next bullet is why use hard money. So banks are not here. They don't lend money for fix and flippers. They're more conventional lenders. They want to go with the positive cash flow of a property. So hard money is used for an empty property that also needs a rehab to get to what's called an after repair value. So for the newbies out there, assuming you're buying a property for $100,000 and you need $50,000 into construction or rehab, that's $150,000. A hard money lender is going to ask, what is the after repair value? Because that's how we base our loans off, which is the after repair value of the asset. Assuming it's $200,000, we're going to lend 70% of that $200,000 or 70% of the ARV to get you to the max leverage possible. So hard money is used for fix and flips. It's a short term, 12 months, interest only, and again, high leverage, low risk, low deposit. Hard money lenders are obviously doing properties that are empty, that are not cash flowing, that need that distressed property that needs to be fixed up to get it to a normal ARV. Excuse me. Okay, so why use hard money for real estate investing? Hard money is for real estate investors with a viable option for those who don't have deep pockets to pay cash for every property. Even though a hard money lender is charging anywhere from 10 to 12%, some or more, borrowing hard money. By the way, hard money is not hard. It's a very easy, quick, short process. Why do they call it hard money? Because years ago, it's a hard asset. The asset is the property. So that's why it's called hard money. So honestly, folks, it is a very easy, transparent, quick process with closing times in your first deal typically taking 10 to 14 days, second deal and onward, 3 to 5 days. So when a property has to be purchased, repaired, coming together for the profit and all that, that's where hard money comes in. I just want to add that a good hard money lender with products, programs, building a relationship with your hard money lender is very important because investors are going to have questions, and a good hard money lender is not there just to deploy capital to you, but to give you sound consultative advice on letting you know what the economics are on your return on the investment and the profits, and giving you a good consultative approach on where the market trends of the property is going. Is it a flipper's market, a renter's market? I mean, I recently had a client who was going to do a deal, and my back office found out that the property, there was going to be a warehouse right across the street being built from my investor. And I told them, why would you want to take this property, especially when you want to keep it or possibly sell it to an investor when there's going to be a warehouse of trucks coming in and out every day? It's not a renter's market, that particular street. And I told them my consultative approach is, even though you stand to make a good amount of money, what's to say that you're going to get that money or even rent it or sell it? So he took the choice of not moving forward, which I believe was a good sound advice. And that's where a good hard money lender comes in. Again, not just to deploy capital, being your consultative approach, if it's a good deal, a bad deal, potential profits, where the market trends are going. So we're here to walk you through every step of the way to getting your deals to a funding and to a closing where you, the investor, can make your profits. So timing, how long does it take to get a deal approved? Honestly, it just takes us 15, 20 minutes. Once you send us a full application, we're going to let you know the exact leverage, the rates, the points, and again, our consultative approach, if the investor needs it, on the economics of the return on the investment and the profit potential, and things like that. Approval criteria, excuse me. With my company, again, it takes us only 15 to 30 minutes to approve. If the investor ever needs a proof of funds specific to a property to give to a realtor, a banker, maybe even to Joe, who's going to be the FHA takeout, we're here to provide those proof of funds totally free for our investors. And for the investors who are looking now, especially today's market, to present maybe 20 offers out there, whether they're doing bird dogging or they're doing their mailers or however they're doing their generations of leads, we're able to provide our investors, our clients who have been pre-qualified with us, we're able to provide a generic proof of funds of $300,000, $1 million, or $500,000, so they can go out and give it to their banks, FISBOs, realtors, lawyers, whatever they have to give it to hopefully get some offers accepted on their purchases. The flexibility, like I said, it's very, 30 minutes tops to get approved. First time to close your deal with a good hard money lender shouldn't take more than 10 to 14 days. I will say that the 14 days right now is only because of now the appraisal guys making appointments, getting in, not getting in. Due to COVID, we're very flexible on that. We could even work with drive-bys, broker price opinion, for properties that are maybe auction.com, or they just simply can't get in because maybe there's tenants in there and due to COVID. So that's a lot of flexibility that you want from a lender. So again, it's not just about the money, the rate, and the points, which is important, but a good lender is going to have products and programs and the flexibility to get your deals done where you can make your profits. So everybody's asking, how does hard money financing work? So banks, do they give hard money loans to investors? Not really. Joe, I guess we'll talk about the 203K and other types of loans, which I'm not too familiar with. But hard money loans, they take, like I said, in the first deal, 10 to 14 days. Second deal and onward, 3 to 5 days. So hard money lenders, we specialize, we quickly close. We have a common sense underwriting, which is very, very important. We're not a cookie cutter lender where it fits or it doesn't fit. We take a common sense approach. We'll work either with, by the way, we work with newbies. We could work with experienced investors, investors that don't have all the capital for their 10, 20% to put down. That's how we work, with a lot of flexibility and common sense underwriting. And that's all we care about, is a safe exit and the profits for that investor to make, because we are not a lender that just wants to lend. We want to know that the investor has gotten their profits so we can get back our money and everybody is happy at the end of the day. So using hard money to deploy capital in real estate investors is for the purchase and renovation of properties, single families, 1 to 4 units. We are a true bridge lender for anybody out there doing multifamilies and mixed use for, again, hard money where it's quick, easy, and short term. We do that as well, but I'm not going to get into that because this is more for the everyday fix and flippers. And I will say, as a lender, people are asking me all the time, is the market weak? Is it strong? I will tell you, New York and New Jersey, the prices are still, they're increasing. They're not decreasing. When you're discussing about properties, maybe in certain rural areas or, states that are not a grand flux of flicks and flips, then the properties are going lower. But strong cities, strong states, the values are staying strong, and sometimes there's even a bidding war. A lot of my clients today, New Jersey especially, they're telling me there's still a bidding war. So let's let you know that. So that's a good thing in a way, and it's a negative thing in a way, but it's good to know that the market is still strong in powerful states. So how do we screen? We screen the borrowers by, just go back a second, Max. So we screen the borrowers by just having a nice pre-qual 15-minute conversation with the borrower. We like to understand the needs, the goals, the strategies of the borrower. Again, we're here to build relationships because it's not about your first deal. Everybody should have a goal somewhere between 5 to 20 flips a year, making themselves a 6-figure income. Because in this real estate industry of fix and flips, it is attainable if you have a plan and a goal to get there. So we will evaluate the property. We will disperse funds to you for the rehab, making a hard money loan very easy and smooth. So for the folks who think hard money loans are no money down, is no such thing, especially today, mid-COVID. Hard money lenders do want skin in the game from borrowers. Pre-COVID, we were at 90% of the purchase, 100% of the reno. Up until yesterday, we were at 80% of the purchase and 100% of the reno. I'm happy to say today that we made a decision to go to 85% of a purchase price for experienced borrowers. For inexperienced borrowers, we're going to be somewhere between 70-75%. But for experienced borrowers, we will go to 85% and 100% of the reno. But there is no money down. Lenders want skin in the game from the borrower. However, I will say, for the borrowers who have a great deal and you're missing a certain percentage of your equity, whether it's 10 to 20% down, I can introduce you to other investors who have the cash and just don't have the properties. I could introduce you to gap funders who come up the money, and you'll make a strategic plan on how to pay them back. So we could be very, again, flexible on helping you get your deals to a closing. Coming in. So today, like I said, well, I shouldn't say today. As of yesterday, we were at 80% of the purchase and 100% of the renos. So, for example, if you're buying a property for $100,000, we would lend you $80,000, and the full reno, whatever that reno is going to be, 100%. We just cannot exceed, in today's times, 65 to 70% of the after repair value. So for the folks who don't know maybe what the after repair value, again, I'm going to take my case before, my example. If it's $100,000 purchase, I'm going to say a $20,000 reno. So that's $120,000 project cost. But if the after repair value, by you doing your comps and making sure that that's an after repair value, and we're going to ensure that with the appraisal and doing our own in-house, research. So assuming the after repair value is $200,000, the max loan we would give is somewhere on a $200,000 loan, about $140,000. You as the investor, it's important to know what your lender's max ARV is, because if I'm going to lend up to 70% of 200,000, that's 140, and you already know that you need $20,000 in rehab. Well, the max allowable offer that you should be putting on that property is $120,000. Just to repeat it again, if it's a 70% ARV times 200,000 ARV, that's 140 grand. And for you investors that know if your rehab is 20 grand, your maximum allowable offer should be $120,000 on the property. So that's important for all types of investors to know what lenders are doing, 65, 70, and even 75. We're going to go back to the normal soon of even 75% of ARV, which is a good thing. So hard money lending always took on a risk. And even today, right now, with this worldwide pandemic, we're taking on a greater risk. And some of my investors just don't understand that the rates went from 10 to 11 or 12, and the points went from, 1 to 2 or 2 to 3. They can't understand that. But unfortunately today, lenders who are in the world of lending today, they're not here to lend and everybody just be rich and we have to take on a risk. Today, lenders are taking on an even greater risk, because that loan to value of a possible purchase of $100,000, if we close it today and the market just goes down by 10%, well, guess what? We just lost 10% of the deal. So not just the value of the purchase, but also the after repair value, which really is every lender's basis. So going back to that $200,000 after repair value, what's to say, if we close on your deal and in 6 months, the value instead of being $200 is $175,000. Well, us lenders would take a great risk and lose out on that. Of course, the investor would, but we would also. So lenders today are taking a greater risk. How do we mitigate that? By either decreasing leverage or increasing the rate, or maybe even asking for interest reserves, depending on the borrower, to mitigate risk to us lenders out there. Okay, so today's rates and terms with hard money. I can only speak for myself, and I do know a lot of my friends in the business. So lenders used to be somewhere between 8 to 10%. Today, hard money, mid-COVID, somewhere between 10 to 12%. And folks, please, when I hear, 12% and 2 points, I'm paying 14%, you're not, because when a lender is doing a 12-month loan and most investors are in the deal for 6 months, well, you just take that 12 month of interest, which is 1% a month, and only comes out to 6%. So please, folks who don't understand the concept, it's not 12 plus 2 or 11 plus 3 points is 14. You're paying interest on only what you use throughout the life of the loan. Some lenders have 9 months loan. You need to be careful for that, because when they're telling you 9% for 9 months, that is still an APR of 12% annually, which is 1% a month. So hard money, not only look at the rate, the points, look at the fees. Our fees I'll get to in a minute, but everybody has rates, of course, which is the interest rate. We don't charge interest on the rehab unused portion. And that is a very important thing to know, because if you have a $50,000 rehab and you're paying 12%, well, you're not paying 12% on that 50,000 rehab from day one. That alone will decrease your monthly payment by 50%. So these are things importantly to know. So going back to the points, I mean, right now, for most lenders that I'm hearing, 2 to 3%, some are charging 2 to 4. Costs that go in, it varies by lender. Our fee is a $9.95 underwriting fee. We do have a private lender attorney that is closing our loans, whether it's actually being there in attorney states or doing it through what we call a virtual closing. So just to let you know, by the way, it's a good thing to know. And again, it's not about the rates, the points always. It's about the products and the programs, what the lender can do. We have virtual closings for other lawyers of our investors, attorneys that can't be present, or for whatever reason, we have to do a virtual. Our attorneys are prepared to do a virtuals, and they've done it already presently. Going back just for a minute for the appraisals, again, if we cannot get in, there's tenants in there, there's owner occupied in there, and they're upset that you bought their house, we'll do that drive-by, we'll do that broker price opinion to get it done. Excellent. Okay, good. Okay, so I call this the 6 C's, considering when funding a property. It's to minimize your risk, to minimize the risk while everybody's here to make money. Lenders are not just looking for high yields, they're looking for safe, secure investments that return our capital back at a solid return on the investment to the investor. So we want to know always what the exit strategy is going to be, whether you're going to sell the property or whether you're going to refinance the property. And when you're refinancing the property, of course, I need to know your score, because we're going to go to people like Joe and say, well, Joe, my client needs to pay us off, and can he get approved with the your Fannie or Freddie Mac or loans that you're doing. So we're here to make sure that, again, you exit carefully, whether you're going to be selling it or possibly refinancing it, to get us paid off and to get your profits done. Collateral. So lenders are looking, like I said, only about the real estate, the hard asset, which is the collateral, its physical condition, the marketability, the profit potential, and amongst other determining factors that include the equity cushion in there, which is the after repair value. So the condition, we want to make sure that the property condition is safe. There's no deferred maintenance on it. The roof is not falling apart. So we do look at pictures before we want to, we will have the appraisal go out there and make sure that the property, has is clear conditions, and there's no, it's a safe market condition to invest in that particular area. Capacity. So we're going to look to make sure that our borrowers has the capacity to close out the terms of the loan. What's the capacity? Well, besides the 20% down, you need to get your rehab done. And if your rehab is $50,000, well, we want to see that you got about 10% of that to get your rehab started. And some investors are going to say to me, well, aren't you giving us the 100% of the renos? We are, but every investor has to have skin in the game, and that skin in the game is by starting to pay off the contractor with at least 10% down, and you're going to get it back on your first draw. Capital. So I always say, first of all, the no money down is very misleading. And like I said, the transactions are very rare. Yes, there are a few, 2 or 3 lenders that I do doing no money down, and we do it, which I'll talk about it after. However, today's real life patterns of no money down do not exist. due to the pandemic and due to what's happening out there. And I just want to say, folks, by the way, just going a little off tangent, that unfortunately we're headed to a recession. And in recession, there's going to be a lot of opportunities. Where there's uncertainty, there's opportunities. If you're going out there bird dogging, driving by, doing mailers, you're going to find properties. People, unfortunately, got suffered losing their jobs, losing their businesses, unfortunate deaths, divorces, people that just want to downsize, people that are just too afraid and don't want to pay their mortgages anymore and more comfortable, paying rent. So there's going to be a lot of opportunities, I feel, in the next two to three years. So we're doing background checks on everybody. Yes, only just to make sure that there's no criminal or other derogatory records. As far as the credit is concerned, we will deal with people right now with investors somewhere in that 650 range. However, if you have less than a 650, we could partner up with somebody with you and for you who has a higher score. And like I said before, if somebody doesn't have all the capital, we could partner up, bring up people there to partner up with. Okay, so the application, very smooth, very easy process. So the way we do it is, what we're going to ask you for, like I said, is just the 6 C's, and knowing about the property, the details, a little bit about the borrower, I should say. We could do the pre-qual on the phone. You could give us a call. You can go onto our website, and we will let you know, about the deal, the rates, the terms, and like I said before, the economics. But it's very important to know that we're here not just to lend you, to make sure that it's a safe and executed agreement. Shouldn't say agreement, execution and making profit. So what we ask for is a loan application, purchase sales agreement. If you have any property insurance information, the renovation budget, us lenders call that a scope of work, and the broker price opinion or CMA, that'll come from an appraisal. To identify the actual loan to value and to identify the ARV. So if you have any deals, you can go. So if any investors, landlords, developers, or property managers that are looking to either buy or find properties or sell their properties, we have an MLS website called, find that flipdeal.com. So I just missed it. Okay. So I'm sorry, folks. I'm sorry. So we have on our website something called a deal calculator for every investor out there that's looking to find out what their return on the investment from their perspective and questions to ask their realtor or their seller. Go to our website for the deal calculator. It's going to help you identify what your profits are and your return on the investment. But again, a good lender is going to let you know internally the second set of eyes. But this is good, folks, to know to go to the deal calculator on our website. Our products, everyday products, is hard money, fix and flips, of course, bridge loans for commercial properties, anywhere from $250 up to about $10 million currently we're doing on multifamilies and mixed use. And then we are a non-bank commercial mortgage lender. So just a quick synopsis, 1 to 4 unit rentals for the investors that are looking to keep the properties. We could put them into permanent financing, currently at a 65% leverage. Scores have to be, unfortunately, 720 or above, 65 leverage. The rate somewhere between 5 to 7%, depending on leverage and depending on the score of the investor. So I was saying before. I'm sorry. Go ahead, Joe.
Somebody threw in a question. Rehab funds. Do they have to come up with the first tranche, the first draw, or do you give a draw at the closing?
So we don't give a draw at the closing. They do have to come up with it up front, or we could just lower the leverage. So if a person, for example, is going to be mid-COVID 85, maybe we'll just make it 80. I mean, it's the same thing. So either way, they do have to come up with it, but some investors prefer 80% leverage instead of 85, and then we'll give them 5% towards the rehab. So we could do it that way. But, most lenders want the investor to come up with it up front to show that they can afford to do the deal. And just an add-on, a good lender is going to be making sure that the investor has that carrying cost. So, for example, if it's a $500 a month payment and they want to know that for 6 months he can make the payments, which comes out to about $3,000, because you never want to lend to an investor or a partner or a client when he doesn't even have the monthly carrying costs. Otherwise, how's he going to even execute and profit on this deal?
So Are you seeing more people flipping it out of the LLC and putting it into their personal names because of the rates that are so low right now for investment properties to hold? Are you seeing that more often now in certain states?
So you're asking me, is it going from an entity on a fix and a flip to a individual because
Yeah.
of the loans that you could do?
Well, because I'm seeing a lot of people coming to me with a hard money loan. They're in the LLC, but if it's not in Pennsylvania, it's not costing them a lot to flip it back into the personal name to refinance and take advantage of the lower rates. Are you seeing that a trend happening right now? Are you,
Yes, I'm seeing it. Yes, case by case, but I am seeing it. Yes.
especially when it comes to credit score, because your minimum for the LLC component is 720 score, and they're really not maxing out LTV on the refinance anyway. They might still have to bring money to the table if there's a change in the value.
Exactly. They do have to bring cash to close if they want to go into permanent with us, because they used to get 80 or 90, and now on
Yeah.
the refi we're at 65. So that is definitely true.
Yeah. So, because you see, if they flip it into the personal name, I might be able to get them 70% or even 75% for that matter on the cash. At least to rate and term out the debt in the personal
Yep.
name, and then they can throw the LLC back onto the title for all. I mean, what I don't know doesn't hurt me, in a sense.
So you do it under an individual, never an entity.
Well, I can do entity. I can do LLC. I can go up to 75% loan to value, but my minimum loan size is $100,000. My rate's around 5% on a 5/1 ARM 25-year amortization. But again, not a lot of people come to me with over $100,000 loan amounts to do refinance holds. Usually they come to me, hey, I got an $80,000 loan. I'm like, that's great. You're going to cash flow great if you find somebody to do it, but it's not for me.
So you could do loans, $100,000 minimum in the 5% range arm. Got it. And then you'll take a, how about the seasoning? Is it 1 year? Is it 6 months?
Well, if the debt is in place and it's seasoned for 6 months, at least, then we can look at the refi.
Got it. Okay.
Okay. I want to see that you have a lease in place. I want rent paid. I want to, and this is the thing, depending on the circumstances, to me, it's no longer amateur night. I want to see tax returns that show rental income from other investment properties. I want to see that this is not your first rodeo. So now that I'm trying to say, hey, no beginners, it's just going to be a little more difficult for them because of everything's going on, because I can't trust rent being paid. I mean, you got 3/4 of Philadelphia, nobody's paying the rent.
Right.
So at the end of the day, if you didn't have Section 8, you were going broke as a landlord in Philadelphia. I mean, that's the truth. Nobody was paying.
It is.
Hey, the governor told me not to pay my rent, so I'm not going to pay my rent, and that's
Right.
what basically happened. So,
Right.
I mean, to me, I think suburbs are going to be better cases where you might be able to get your rents paid right now than some of these urban cities, because they're not as educated of a tenant. You know what I mean? And they're typically a little more hostile with the landlord because they think the landlord's got something over on them in the city, so they want to try to take advantage of the circumstances. Where the suburbs, you got there's a little more of an educated renter. They have obviously a different type of job environment, and they know they got to pay the rent, or eventually they're going to get thrown out.
Right.
So it's definitely an impact right now. I do like that your LTC, loan to cost, is higher than what I've heard, because most guys are pulling back and they're going 80/80 on purchase and rehab.
80 on per. No. Yeah. No,
Yeah,
we're never that
you're
way.
doing
We're never that way. Yeah.
No, but some of them have done that to stymie off a lot of the beginners. They really just want to go with more seasoned investors at this point.
Right. So your product, even though it's a 5/1 ARM, 25-year AM, you said 70% LTV, but you want it leased for how long? 3 months? 6 months?
I want a lease in place in the first, the rent covered. You know what I mean? Now this is the case. I mean, the product, the minimum loan size is $100,000, and again, it's got to fit the certain box. That's there's some moving parts to it, but it's open to discussion. So I think we're on the same page. We understand. Listen, we welcome newer investors in the market, but we all can agree, Max and Marty, I think we can all agree, this is a time you partner with experienced professionals in the field.
Yep. Very much true.
Is there anything else that you're seeing that's standing out in the last recent weeks as things? Now, New Jersey just announced they're reopening today. Okay. So do you see any changes in the demeanor of, say, the people that you work with, of course, with the money, per se, the money side of things, to the investor? Are you seeing a different type of investor calling out to you? Are you getting less wasted calls and more kind of precise calls?
Getting a little more precise calls. I am telling my investors, by the way, I say, you called 100 people before COVID. Why not call them again, those 100 or 200 or 300 people? Chances are they're in a situation now and they need your help. So that's a free generation lead right there of their own database, to help them, get some from an old lead to get a new lead into a deal. So that's working, and I'm advising my clients do, like I said, the drive-bys, do the mailers. I can give them. I'll tell everybody right now, Craigslist has a 50% increase in property listings right now because sellers don't want to pay that 5 or 6% realtor fee, and they're desperate, and it's an off-market deal. And I already had 2 clients in about 2 weeks that already got their first deals under their belt. Shouldn't say their first deals, but they got a deal under their belt already. So it's a great avenue to find deals. So everybody listening out there, go to Craigslist, put in the filter, your city, your state, your criteria, call up the people, find out their pain, find out their needs, their wants, and hopefully you can make a deal happen that way. I'm also telling all investors and clients and partners out there, go to Realty Track and Property Shark. There are a lot of people in pre-foreclosure right now that have not paid their mortgages due to various reasons. And then once you find that property, go to the county clerk website, find out the information, who the seller is, who the owner is, and call them up and see if there's any situation there that can be helped. Where there's pain, there's gain, and it's out there.
I mean, I'm literally originating and locking up 2 to 3 loans a day, Monday through Friday.
Okay.
And stockpiling more loans for refinances because, like today alone, the rates were in the 2s on a 15 or 20 year on a primary residence.
Okay.
Investment was in the 3s, whether it was a 30 or 20 year or 15 year. I mean, again, I think it's really curbing the qualified borrower. The qualified borrowers smell the opportunity. They smell it. They see it. If you got a 700 score or better, you're getting top rated rates. There's no more squeezing in things. Listen, you got to have credit. You got to have equity in a property, and it's got to be the right asset type to get the right opportunity.
Exactly. So to add what you were saying, we did get an influx of calls, people that wanted to refi their properties to get cash out, whether, just keep them afloat for the next 6 months to a year or to buy additional property. So refis on the permanent financing, yes, we had a very big influx of that. On the hard money side, I'm sure most lenders would agree, March and April was a very, very slow process. Now that we're in, early June, it's increasing the volume, thank God. More phone calls, more people are getting out there. The weather's comfortable. People are getting, like you said, the states are opening up, so people are feeling comfortable to go out there and do their homework.
Well,
So
I'd like to make an announcement for you, Marty, too, because
sure.
you don't know this. It's just I'm going to be making as of the 15th of June. I'm going nationwide, and I'm going to become senior vice president of Federal Savings Bank, which is based out
Awesome.
of Annapolis, Chicago, New York, and I will be their Philadelphia and New Jersey offices. So that's why I have a much broader program base. I loved it at First Trust Bank, but it's going to be all about the programs. How many programs can you offer to clients? You and I both know, and Max could agree as well, in 6 months when these foreclosures start hitting the streets, you're going to need 203K and you're going to need home style loans for owner occupied. You guys can't touch owner occupied. That's going to be the shoehorn to get me in front of a lot more clients. They don't have that at First Trust.
Right.
Federal Savings sold me on their products. I have like 20 more products to work from. But so again, I understand why you're taking a nationwide approach to everything, because if you're not in it all the way, you're done.
Exactly.
You can't be halfway on this. So
I'm sorry. I just want, since we lend nationwide, some of our hot states like Texas and Florida, Georgia, Atlanta, they are also still very strong. I was talking to my investors in March, April, and May. They were looking, finding, and closing deals. So it was happy news to hear from the lenders and from an investor standpoint.
And those are the states that are having the least amount of issues on COVID, actually. So
yeah.
Florida and Texas alone. So Texas has
Yeah.
always been a very good multifamily, single family through four family environment. It's
Right.
always been a strong place to be. There's a lot of money down there, especially in the universities. San Antonio market, I mean, probably one of the most unbeatable markets in the country.
Exactly.
So
Exactly. And I just want to tell everybody out there, it's not about what you know, it's about whom you know. So when you have a good hard money lender, when you have a good mortgage lender like Joe, and you're meeting people on these webinars and seminars and events, I always say it's about networking, which is an opportunity, which is to grow. Growing is by calling the people that you meet, engaging, making that relationship, because you never know how I could help you, Joe could help you, a title, insurance, a lawyer, anybody out there that could help you in this real estate industry. And that's what it's all about.
your network is your net worth. And I wanted to let you know, I'll be reaching out to you guys about the 23rd of June. We're going to have hopefully a reopening event in Cherry Hill. Love to get you
Right.
guys involved and send it out to your network as well. It's going to be indoor, outdoor. We're going to have a tent. We're going to have food. We're going to have music. We're going to be capped at 100 to 200 people because of the indoor, outdoor component. But we have a green light in New Jersey at this point. So as soon as I get all that information, I'll be sending it out to you guys. I want to thank you for the detail on here and coming back for round 2. We didn't get the other son. We got the better looking one with the bald head. So we'll just have to let the other one go. Next time we'll get him back on.
All right, next time.
Yeah, and we'll hopefully have an in-person event where you guys can come back out sooner or later. As soon as we can schedule it, we're going to invite you guys out, okay?
Ready, willing, and able. Is there any questions and answers for anybody on there?
I think we got everything addressed for the most part. We've been answering them there, but I want to thank you guys for coming on to Smart Real Estate Podcast. Again, my name is Joe Scorese. I am a mortgage lending specialist with Smart Real Estate Podcast, and my co-host Yardell Perkins, our social media expert. We have the Chera family on here talking about hard money and the stages of how to facilitate it. And we'll make sure we get all our information out. We'll be sending this out to our network, Marty and Max. As soon as we get it cut and edited, Yardell will get a copy of it back to you so you can send it out to your network as well.
You got it. And thank you, everybody, for your time and patience, and looking forward to working with anybody and everybody. Just want to add one quick thing. If anybody's looking for a sales position, we're looking to hire in-house loan officers in New York and New Jersey. Give us a call at 718-285-0806. As always, we're here to help you grow in your business.
Guys, thanks a lot. Be
Joe,
well.
thank you so much. And Yardell, thank you also.
Yep, and we'll see you hopefully in late June. Be well.
You got it. Thank you.
Everybody have a great night. This is Joe Scorese at Smart Real Estate Podcast. Be well.